Coming up today, stocks start the week higher, earnings season ramps up, a big week for crypto, the latest moves from Alphabet, what to expect from inflation, and everything else to get you prepped for this busy week on Wall Street. We're going to have a good one, guys. Let's go. And welcome back to Click Capital, everybody. I hope you had a great weekend. We're off to a positive start here on Wall Street. All the indices finishing higher, led by small caps once again. But looking underneath the hood, checkered breadth, just like we saw last week. Industrials catching a bit in financials, perking up as we officially kick off Q2 earnings season this week. We get to hear from some of the biggest banks on Wall Street and what their current takes on the economy are, along with their outlooks for Q3. And we do have quite the busy week. In addition to earnings, it's going to be another big week for trade headlines, crypto week, CPI inflation, all whilst the S&P 500 sits just a few points below all-time highs. And we did just hear over the weekend Trump announced 30% tariffs for both Mexico and the European Union, effective August 1st, putting the squeeze on those two important trading partners in which we still could get a deal in the next 2 weeks. But is the market betting on another taco trade where Trump bends to the whims of the market? Well, maybe not this time, because unlike early April, markets aren't getting created here. They're at all-time highs and yields are relatively calm as well, giving the president significantly more bargaining chips. So the 1st of August deadline for tariffs may not get extended, and maybe that's when we could get a 4, 5, 6% pullback in the market. Just looking at the VIX, super calm. Did pop up a little bit today, going into inflation tomorrow, but still more than 2 full points below the 200-day moving average. And around that 1st of August deadline is thin holiday trading. And just looking at the Spider ETF here, we are coiling up in a super tight triangle. Realize volatility getting down to lows. Something has to give here, but will it break up or down? Because after tomorrow, we've completed the first half of July, which typically tends to see most of the gains for the month and is actually the best 2-week period, seasonally speaking, of the year. And typically the second half, we see more consolidation. But that's just in the short term. Zooming out a bit further, we've had such an amazing V-shaped recovery. Technically speaking, that typically bodes well for really good forward returns. After the NASDAQ comes off 20% from a high, then gets right back there within 50 days. 1 month to 12 months later, we're high 100% of the time, and look at those average gains, 42% a year later. One of the strongest technical patterns you'll ever see. And on the back of that huge momentum thrust in the market, which we've seen a 26% gain in the last 3 months, again, that really bodes well for forward returns. Average gains are 21% 12 months out. And Wall Street hasn't fully caught back up yet either. Looking at some data from last week, year-end price targets for all the big banks are still below that from where we started the year. And you can see how much they chased the market down in early April on Liberation Day, only to chase it back up. But just like that July seasonality would suggest, we could also be on the cusp of a pullback given how many consecutive days the S&P 500 has traded above its 20-day moving average. Currently at 54 days, looking back in history, we've only gone above that once before in late 2020. And so even though the market doesn't appear to care about trade deals and tariffs right here, and maybe actually discounting that too much. That is, of course, Europe and Mexico do come to the table in the next 2 weeks before the start of next month. Then the market would have correctly forecast that it is once again a nothing burger. So what will the market look to then next? Well, as usual, the biggest driver of the stock market, corporate earnings. Big banks set to kick off this week, and they've been having some stellar returns themselves. Looking at the average Q2 gain for the top 6 banks, 16%, 60% greater than the S&P 500. And we can see that looking at the charts of some of them like JP Morgan. And so banks like industrials are rate sensitive. So they may be getting excited by the prospect of lower rates, easing pressure on their balance sheets and their huge hordes of bond holdings. But also they got the strong structural tailwind of deregulation, loosening capitalization requirements that were put in place a few years after the GFC. So we'll be paying attention to them this week, along with their outlooks on the economy and a few other key names this week. Taiwan Semi, Netflix on Thursday, a few industrials on Friday, and then next week, I'm really looking forward to Alphabet, Google, and Tesla. Interested to see their numbers and how the market reacts. Then we'll really get into the thick of it the last week of this month, with most other mega cap techs coming through with their numbers as well. It's also crypto week, as Bitcoin once again hits another new all-time high. There's plans to introduce 3 bills that could have a major impact on the US financial system. Got the Senate already passing the Genius Act, which will get a straight up vote in the House this week. And that legislation would set rules for how stablecoins are issued and managed. And so they're pegged to tangible assets like the US dollar, backed by treasuries, and are going to help speed up payment processing. Lawmakers also plan to introduce bills that would change how digital assets are classified and prevent the Fed from ever creating a digital version of US currency. And so the market's already been front running all this stuff, pretty much priced in as a done deal. Would be a huge shock if it didn't go through. Prediction markets got it around 95% odds it will get done. And this is a huge tailwind for America's largest crypto exchange, Coinbase, which it wasn't even a year ago, was under attack from the SEC. USD. But that position, along with Gary Gensler, is now long gone, and the market has come around to this stock in a big way. Once again, charging higher here again today, along with Bitcoin itself, briefly getting up to $123,000 a coin, and the pipeline is heating up in the crypto space. One of the first to offer retail investors an investment vehicle for getting exposure to Bitcoin, Grayscale, filing to go public. They got more than $33 billion in assets under management across more than 35 investment products. And there's their flagship product, the Grayscale Bitcoin Trust, $20 billion assets under management, which was the longtime leader in the space until BlackRock's iShares came along. Now got a whopping $80 billion assets under management just in this ETF alone. And we just heard today that it's now their most profitable ETF product. But Bitcoin's becoming old news. It's actually Ethereum that Wall Street and big institutions are coming around to in a big way of late. With Bank of America putting out a research note today saying they believe infrastructure providers such as Stripe, which is yet to go public, or the Ethereum platform on top of which public chains are run, such as the one being used by JP Morgan, pilot its tokenized deposit JPMD, could potentially become the new rails for which digital assets run on top of. And that's because Ethereum has some key differences to Bitcoin. It's much more programmable, much better suited for smart contract, tokenization, stablecoin, institutions process transactions on. And a key difference with Bitcoin is that Ethereum can be staked and earn an actual yield. But for me, it's really their dominant market share in stablecoins, I think, is going to be how traditional finance transitions into the digital economy. But also other things, NFTs, DeFi, prediction markets, gaming, even real-world assets, along with new ETFs coming onto the market that incorporate staking. I think there's a lot of bullish tailwinds here for Ethereum. And I think a lot of people will be surprised to know that after they introduced base fee burning in August 2021, which destroys a portion of ETH in every transaction, when network activity is high, more ETH is burned than issued, making it actually net deflationary at time compared to Bitcoin's fixed supply. And with all this huge demand and activity lately, ETH supply is actually slightly declining. So Bitcoin's scarcity is absolute, but ETH's is adaptive, and ETH could actually become more scarce than Bitcoin in the long run if usage stays high. Most popular way for investors to gain exposure to Ethereum, the iShares Ethereum Trust Ether. Still relatively quite small, just over 5 billion assets under management, but we can see the activity has been picking up a lot this last week. Just like it has done with Ethereum treasury companies. Some of these companies actually dumping all of their Bitcoin to go all in on ETH. One of the most noteworthy, SharpLink Gaming, gobbling up as much ETH as they possibly can. But that once again saw their stock rise over 10% today, still ripping here after hours as I speak. Another one you want to keep your eye on, BitMine Emergent Technologies. Tom Lee's chairman of this one with a similar treasury strategy of accumulating Ethereum, and my favorite that I have a bullish position in, BitDigital, given the quality of talent on their board of directors. And so this big secular change in finance to stable coins is going to have big ripple effects, and it kind of also plays into the big secular trend of artificial intelligence. And not just finance, but how the world as a whole operates. And what company has been kind of left somewhat out of the spotlight, even though they're still immensely profitable thanks to advertising, but is now using those huge cash flows to try and become the leader in AI, is Meta, the owner of Facebook, Instagram, and WhatsApp. And we just got news today that they're building massive gigawatt data centers. After already spending big on trying to get the best AI talent in the industry, we just heard from the Zuck today. For our super intelligence effort, I'm focused on building the most elite and talent-dense team in the industry. We're also going to invest hundreds of billions of dollars into compute to build super intelligence. We have the capital from our business to do this. So they're actually building several multi-gigawatt clusters. First one called Prometheus is coming online next year. And there's a look at Meta, which we hear their earnings in a little over 2 weeks from now. And I wouldn't be surprised if they blow it out of the park once again, as nothing seems to be slowing down these huge tech companies. And the one I've been profiling the most in these daily videos of late, due to it having the best valuation, Alphabet Google is also competing for top position in AI. Also looking to poach some of the best and brightest in the industry, including AI coding startup Windsurf's chief executive co-founder, as well as some of its research and development team. Google paid $2.4 billion for the AI talent and non-exclusive licensing rights to some of the startup's technology. But it's not just AI. You could think of Alphabet as a tech conglomerate. With news also out today, they acquired a new stake and shares of AST Space Mobile. Coming out of Midland, Texas, another hot stock of late, actually competitors to Starlink, offering internet services broadcast from satellites in space. 16 billion market cap is actually now Alphabet's second largest holding in their portfolio. I think a lot of people will be surprised. A lot of these tech stocks run their own portfolio, with ARM Holdings, a chip maker being their largest, and they're also interested in the space economy. Planet Labs, which I recently just invested in as part of my stock picks as well. Tempus AI into healthcare, and a few other healthcare related stocks in addition to the hot Oscar Health. And it's not just publicly traded securities either. they also have big stakes or outright ownership in a number of other futuristic brands. Bellwether, 280 Earth, cybersecurity, food, robots, glasses, stratospheric balloons, renewable energy, and of course probably their most popular, Waymo, robotaxis. And because they have such wide-reaching interests, not all of them need to work out. Just one of them working out can easily pay for the cost of all of them and some. Looking at the daily chart, actually breaking out here today to new multi-month highs, as we're a little over 2 weeks away from earning. And speaking of the space industry, stock I profiled here on the channel 2 weeks ago, rocketing here again today, pun intended. Rocket Lab, fueled by a deal with Europe and on the back of a string of successful launches, they're a big-time competitor to SpaceX, which, like I said, due to the falling out between Musk and Trump, may have a little bit of a political tailwind, and definitely at least with the attention investors. This is a long-time retail favorite stock, innovating with rockets and space infrastructure due to huge demand for these services from companies from many industries, including government, and is charging higher again today, looking at the stock up 10%, helping many other stocks in the industry as well. Black Sky, still on a parabolic run, and AST Space Mobile, which Alphabet just recently invested in, also perking up there. And don't forget about the closely related eVTOL and drone industry, also getting some action there today. Joby Aviation, and the one I profiled on Friday afternoon, I said to keep an eye on. Good chance it's going to become a retail favorite, Red Cat Holding. Getting a momentum thrust signal there today on big volume, up over 20%. And so if you're interested in these hot stocks, growth stocks at the frontier of innovation and new technology, pushing humanity forward, then make sure you subscribe to this channel, Click Capital, as I regularly do little mini dives into stocks like Red Cat and other exciting industries as this secular growth bull market accelerates. And don't forget about some of the key commodities that are needed to power these industries. Silver, been a big one. Saw a good move up on Friday in the Global X Silver Miners ETF, as the underlying commodity once again broke out to decade highs. And again, my momentum thrust indicator firing off, giving us an up signal there, just like it did on the 9th of April. And you also want to keep an eye on the Global X Copper Miners ETF, COPEX, having a little multi-day pullback here after it too has recently been seen some increased intention and sharp breakouts. Copper is also important for the electrification of the world. And another key big secular trend, the world coming back to nuclear energy. Once again, the states loosening regulation, looking to get behind it. Uranium, with another ETF from the Global X fund managers. URA having a good day here, along with all the other related stocks in the sector. The largest uranium miner in the world, Cameco, and of course, the developers of the new technology, small modular reactors. Instead of the big old school nuclear reactors, which cost a lot of money, take a lot of time to build, these companies are building made to order, plug and play, run on site, tailor-made to companies' needs. Definitely going to be the future of nuclear energy. Just moving on to the macro, well, we've got all these new secular trends gathering attention and momentum in the stock market. We still have some softness in the underlying US economy, the housing market being one of them, as we've had these persistently high rates for some time now, and that would usually send the economy into a recession, which so many people have been waiting with bated breath for a few years now. Still hasn't come. The AI revolution has overwhelmed it, in my opinion. But 7% mortgage rates are slowing home sales, home building, and home price growth, with some economists saying that could turn into a full-blown headwind. And there is a point, because the housing market is huge, does have ripple effects across the economy, and currently rental affordability is near all-time highs relative to mortgage affordability. And that's due to the mortgage payment to income ratio being at highs. In other words, for the last few years, it's been much better to rent than buy a house. But it's not just housing that's soft, it's also just the cost of living for most Americans, with them now spending more on healthcare than groceries or housing. That's been a huge trend over the last 20 years, the exorbitant cost of healthcare. And you compare that back to the 1960s, it's just a fraction of even groceries. In fact, Americans were spending more on clothing and footwear. And that was a time when it was just typically the man that worked and the woman would be at home with a couple of kids and they could still afford everything. Nowadays, most men and women now work and struggle with the cost of living. What happened? A big part of it is the growth in currency supply, which for non-asset owners has been a huge structural headwind, especially the last 5 years, with the Federal Reserve more than doubling their balance sheet, taking it from $4 trillion in early 2020 to $9 trillion less than 2 years later, orchestrating a huge expansion in the supply of currency, which was no surprise to see inflation at 40-year highs, which Jay Powell said it should be transitory due to, quote, supply chain disruptions from the pandemic, unquote. Didn't quite turn out that way. He had to do the fastest rate hiking cycle in history to get on top of it. However, that was now 3 years ago, and he may have been so rattled from being so wrong, he's afraid of doing it again, only to yet make another mistake. We'll get a look at that tomorrow, with year-over-year inflation expected to come in at 2.7% as we get the latest consumer price index. And there's a look at the market's odds that we'll get a rate cut in September. Currently, about 63%. We'll check in again with these numbers tomorrow after the CPI report. And there's a look at Wall Street's forecasts for tomorrow, thinking it should be a little bit less than 0.3% month over month, which is a little bit of an uptick from May. And if tariffs are going to have a material increase on inflation, we should be starting to see it now, as it has been over 3 months since they've gone into effect. But according to the best measure of inflation and the company behind it, they think the Fed's sleeping, and they think actual inflation in the real economy is tracking on a one handle, while the Fed's still on a four handle. And that's why they're calling for agile and efficient monetary policies, which require reliable, high-frequency data, as the Fed uses lagged BLS data to postpone cuts. And once again, Jay Powell and his team finds himself in a hot pool of controversy. Not his first time. In 2020, his mates were doing a little house dealing, trading their own personal accounts ahead of key Fed announcements. Jay come under scrutiny as well for using the Fed's unlimited buying power to buy up municipal bonds, for which he just so happened to be a holder in as well. Another coincidence, right? This time, him and his mates want to spend $2.5 billion US dollars, giving their new offices a facelift. Excessive and unneeded spending has raised the eyebrows of a few in office, and whether that can be grounds for an early dismissal of Jay Powell, who's supposed to leave in May next year. And so if we don't get the cut in September, I think we could see a bit of a showdown, especially if CPI hasn't materially ticked up, and I'm not just talking 0.2 or 0.3%. If it hasn't gone well over 3 and he's still on hold in September, I think they're going to come for him in a big way. And we're seeing the odds build that Trump will remove Jay Powell. Still quite low here at 18%. That is nonetheless still a real possibility, which should get the market excited even more, because it's pretty much guaranteed we're going to have lower rates next year, as we'll no doubt get a super dovish new Fed chair. But if Jay Powell can get removed, that'll probably shake markets initially on the shock of it, but it should be another buy the dip, because that just means lower rates are coming sooner. Moving on, we're still getting rumblings in geopolitics. Trump's been trying really hard to resolve the Russian-Ukraine war, for which we've seen Ukraine actually come to the table and agree to US terms. And even though we hear the same rhetoric from Putin, his actions suggest otherwise. It appears Trump's had enough of talking and instead is going to play ball with Putin, meeting with NATO chief to dial up the offense and actually send Patriot defense system to Ukraine, which could preempt an offensive move for Ukraine if Russia can't bite back so hard, or at least puts them all in a much better negotiating position. In addition to threatening 100% tariffs on Russia, even though that's not really material because the states only buy a couple of billion worth of goods from Russia each year. They're already being sanctioned to hell. But it looks like markets took notice. Aerospace and defense stocks significantly outperforming the S&P 500 here today, up over 2% on volume, looking at the ITA ETF. But commodity markets not too worried. Gold still quite tame, consolidating for a few months, as is crude this last few weeks. The tail risk would be a military event directly between America and Russia, but as spooky as that sounds, it could actually turn out to be a nothing burger, because the Russian military, which has actually been struggling with the tiny Ukrainian military these last 3 years, is simply no match for the dominant US military, and may actually turn out to be a chance to shut up Putin once and for all, just like it did with the Iranians. And just wrapping it up here today with a few other key stocks. Palantir, once again breaking out to a brand new all-time high. Robinhood still drifting higher. Tesla holding up, even though year-over-year deliveries have been way down. The market's just excited about robotaxi ramping up. Let's see what happens after earnings next Wednesday. But of course, the focus this week will be on inflation, big bank earnings, and crypto week, with the House looking to pass the Genius Act, the watershed moment for stablecoins and Ethereum. That's all I got for you today. Thanks for tuning in to the Daily Market Review, and I'll be back again this time tomorrow. Cheers.